Brazil just dumped the dollar to borrow in Chinese yuan. Japan just bought sanctioned Russian oil on a blacklisted ship with full US approval. And China, it's about to unleash a global stimulus wave at 2% interest, while America scrambles to sell bonds at 6.7% just to stay afloat. This isn't a forecast. It's the unraveling of a system in real time. BRICS isn't challenging dollar dominance. They're replacing it. Quietly. Relentlessly. And now even US allies are asking, why pay more to stay loyal? Because if this bond rebellion spreads, Washington won't just lose reserve status. It could lose control. Stick around, because what's collapsing isn't a currency. It's America's financial command center. In 2024, foreign investors held nearly $31 trillion in US assets, including $7.6 trillion in government bonds. But the quiet exits have already begun. Brazil is preparing to issue sovereign debt, not in dollars, not in euros, but in renminbi, marking a clear shift from the dollar-dominated order. Bloomberg reports this marks Brazil's first ever panda bond, and it follows China's deeper push into Latin America, including nearly $40 billion in bilateral deals since 2022. While Washington remains distracted by tariffs and deficit fights, nations like Brazil are not waiting for permission to diversify their debt markets. It's a diplomatic move as much as a financial one, said Graham Stock of RBC Blue Bay. The dollar's role as the global borrowing standard is being actively rewritten, and this time, it's not just rivals walking away, it's US trade partners. The dollar hasn't collapsed. But when former allies start using China's currency to hedge risk, the real collapse may be trust. And that's much harder to fix. In June 2025, Brazil issued $1.25 billion in 10-year dollar bonds at 6.73%. Borrowing in RMB would cost them as little as 2%, a figure that RBC confirms could be less than one-third the cost of dollar or real-denominated debt. But this isn't just about lower yields. It's about insulation from US financial policy. As Washington hikes rates and fuels market volatility, BRICS countries are calculating that RMB exposure, while risky, is now more stable than the US dollar. Brazil also enjoys a $44 billion annual trade surplus with China, giving it a built-in cushion to manage currency risk. According to Financial Times, this Panda Bond initiative is Lula's clearest signal yet that Brazil no longer sees the US as its default creditor. And if borrowing cheap RMB means greater trade alignment with China, Washington could find itself holding bonds that fewer nations want, and watching as rivals become lenders themselves. The US froze $300 billion in Russian assets in 2022. That single act, now described by Bloomberg analysts as a wake-up call to every central bank, pushed global institutions to rethink holding dollar reserves. Then came Trump's 145% blanket tariff on Chinese imports, announced in April 2025, an embargo in all but name. According to Reuters, China's countermeasure, a 125% reciprocal tariff, has rerouted trade flows and decimated U.S. agricultural exports to Asia. But behind the political rhetoric is a fiscal imbalance Washington can't fix. Its entire capital account surplus depends on foreign demand for U.S. debt. As bond yields rise and demand stalls, even allies like Brazil see U.S. borrowing as a premium cost with volatile politics. As one São Paulo-based bond trader told WSJ, Trump didn't invent the weaponization of finance, but he's made it riskier to rely on U.S. trade, and Biden's asset freezes guaranteed no one will forget it. In June 2025, Japan legally accepted a sanctioned Russian oil shipment using a blacklisted vessel with U.S. approval just to keep its LNG supply stable. That alone would have been scandalous 5 years ago, but today it's policy. Japan, facing a 3% drop in exports in May and a tightening energy subsidy regime, is prioritizing survival over symbolism. According to data from LSEG and Reuters, the Aframax Voyager docked in Kakuma discharged 600,000 barrels of Sakhalin blend, crude, and left. No fines, no backlash. This is the new blueprint. Geopolitical red lines are now conditional. When allies quietly rewrite the rules and the US accommodates, it signals that the economic order built on sanctions, reserve currency status, and global compliance is beginning to erode from within. If Tokyo can bend the rules for oil, what stops Brasilia from doing the same with bonds? Japan, a G7 ally and the world's third largest economy, just resumed Russian oil imports for the first time in over 2 years. Even though the tanker was on US and EU blacklists, the cargo, 600,000 barrels of Sakhalin blend crude, was delivered in June 2025 by the Aframax Voyager and received under a waiver from the US Treasury's OFAC set to expire June 28. Taiyo Oil confirmed to Reuters the purchase was, quote, at the request of Japan's Ministry of Economy, Trade, and Industry, to stabilize LNG production, which powers roughly 36% of Japan's electricity grid. With Japanese exports already falling 3% year-on-year in May and Trump's steel tariffs threatening $1 billion in annual exports, Tokyo has chosen fuel over politics. According to Bloomberg, Japan imports over 90% of its oil, and officials privately warn that without energy flexibility, industrial contraction is inevitable. Sanctions were designed to isolate Russia, but now they're isolating the US from its own allies' energy calculus. BRICS nations are no longer just coordinating trade. They're actively building a parallel financial structure where the dollar isn't welcome. Brazil's Panda Bond, expected to launch in late 2025, is backed by a $44 billion trade surplus with China, creating natural demand for RMB-denominated finance. According to Bloomberg, the RMB now ranks 5th globally in SWIFT transactions, with a 4.2% share, up from just 1.6% 5 years ago. As India, Saudi Arabia, and Russia explore similar RMB instruments, BRICS is becoming a capital ecosystem rather than a political coalition. Issuing debt in Yuan is as much about future-proofing as it is about cost, said Graham Stock of RBC, and that cost advantage is measurable. RMB 10-year yields are under 2%, while dollar debt is surging towards 7% for many emerging markets. If BRICS starts pricing global commodities in yuan, while issuing credit in the same denomination, the dollar may find itself locked out of a system it once dominated and unable to re-enter. China's consumer price index hit just 0.3% in May, and the producer price index fell for the 13th consecutive month, according to the National Bureau of Statistics. Deflation, not inflation, is Beijing's problem, and that gives it room to inject liquidity fast. Bloomberg reports the People's Bank of China is preparing a 100 basis point reduction in reserve ratios, potentially unlocking trillions in new lending. If Beijing unleashes large-scale bond purchases or cuts rates again, renminbi bond yields could fall further, making dollar-denominated debt even less competitive. If the US is in a tightening cycle and China's easing, capital will eventually move, said Barclays economist Jian Chang. As China rebalances toward consumption, rising imports will create deeper yuan liquidity abroad, reinforcing the shift already underway. But this isn't theoretical. Brazil, Argentina, and the UAE are already piloting cross-border RMB settlements. The global bond market may soon split not by rating, but by allegiance. Japan's exports fell 3% year-over-year in May, the first negative reading since 2022, according to Japan's Ministry of Finance. That same month, a sanctioned Russian tanker delivered 600,000 barrels of crude to Japan, legally, under a U.S. waiver set to expire on June 28th. The oil was needed to stabilize LNG production, which supplies about a third of Japan's power grid, according to Reuters. With Trump's new 10% baseline steel tariffs threatening over $1 billion in Japanese exports, Tokyo is adjusting its strategy for survival. Energy costs have surged as domestic subsidies are withdrawn, and China's manufacturers, according to Keishan, are slashing global prices by up to 34%, forcing Japan to cut input costs wherever possible. In this game, pragmatism always wins, said Taro Hasegawa, an energy policy advisor in Tokyo. Sanctions were once a tool of leverage, but now, even close allies are reshaping their own rules to stay in the game. Treasury Secretary Scott Bessent faces a trilemma: preserve dollar dominance, stabilize Treasury yields, and support Trump's tariff-fueled industrial policy, all without collapsing foreign demand. But, well, the math is uncooperative. According to the Congressional Budget Office, U.S. federal deficit is projected to hit $1.9 trillion in fiscal year 2025, with net interest payments on debt surpassing $1 trillion for the first time. Meanwhile, the foreign share of U.S. Treasury purchases has declined to 30.2%, the lowest since 2003 per the Treasury Department. With inflation sticky and real yields rising, analysts at Morgan Stanley warn that bond auctions could soon require emergency demand restoration mechanisms, which is really just a polite way of saying buyers are vanishing. China is already reducing dollar exposure, Brazil is pivoting to Yuan, and Japan, despite its alliance, is hedging against dollar instability. Bessent's margin for error is closing fast. He can subsidize tariffs or service debt cheaply, but not both. Something has to give, and it won't be painless. If Japan can buy sanctioned oil with a blacklisted ship, and Brazil can finance its future in Chinese currency, what does it say about the so-called international order? Not collapse, but quiet abandonment. Dollar loyalty is being replaced with hedged pragmatism. Countries aren't burning bridges, they're building alternate routes. And as BRICS matures into a lender, not just a club, the US is finding its playbook outdated, its leverage diluted, and its assumptions untested. The deadline on Japan's waiver is June 28th. Brazil's Panda bond could be issued by year-end. And Bessent's bond auctions? They're happening now. So, here's the real question. When everyone's rewriting the rules, what happens to the one country still playing by the old ones? Drop your answer in the comments, because this isn't over. It's just the first chapter. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.